Hello everyone, welcome to chapter 26. This chapter is going to be all about swing trading and its details. We'll go over the two different approaches to swing trading, the time frames used for each one of those approaches, and the actual process of evaluating whether which approach is good for you. We've already discussed intraday trading before, and this video is going to be about swing trading. And by the end of it, you'll have everything you need to know about swing trading, and you'll be able to decide whether it matches your personal taste or your personal style or not. Let's get in the chapter. Let's first of all break down what swing trading is. Swing trading is the style of trading in which we focus on capturing price movements over a period ranging from a few days to several weeks. Our main objective and focus is on capitalizing on the swings within a larger order flow or candle range, and our aim is to profit from price movements and fluctuation during the weekly and monthly range expansions. That's basically the simple and basic definition of swing trading. We'll go over the specific method or approaches in the next few slides, but for now, let's dive into the specific characteristics that actually define swing trading. Number one, time frame. Swing trades typically last 2 to 5 days, but also they also can extend to a week or even two, depending upon market conditions. This time window gives you enough room to capture meaningful price movements without the intense demands of intraday trading. Next up, we're going to talk about the goal of swing trading. The primary objective of swing trading is to exploit price swings within a high time frame order flow trend or range. By focusing on these larger moves, swing traders can target higher pips compared to short term traders like scalping or intraday trading. Number three, flexibility. Swing trading basically acts as a middle ground between intraday trading, whose trades are short term and their frequency is higher, and position trading, whose trades are long term trades that last weeks or even months. This flexibility makes swing trading suitable for a wide range of traders, including those with other commitments in life. Now, let's talk about the benefits of swing trading. Some of its advantages are the following. Number one, less screen time. Unlike day trading, swing trading doesn't require you to monitor the market constantly throughout the whole day. Instead, once you've placed your trade and set your stop loss and target, you can let the market play out without constantly monitoring the charts. Number two, it's suitable for those traders who are busy and have other commitments in life. Swing trading is ideal for those traders who have other commitments in life, such as a full time job, studies, or family responsibilities. So, if you are a trader who also have these other responsibilities, then maybe swing trading is ideal for you. It allows you to trade part time without compromising on your strategy. And then, last but not least, potentially higher returns. By targeting larger price movements, swing traders can achieve higher returns compared to intraday trading because since you're holding trades for longer, you benefit from capturing the broader trends and the significant market moves. And similarly, the transactional costs are also lesser for you as compared to intraday trading, and the commissions and the slippage and spreads will also be next to none for you because you are trading on the higher time frame. If you are someone who prefers to analyze the market at your own pace and isn't looking for the fast pace of intraday trading, then trading might be the perfect fit for you. It's about focusing on the bigger picture, aligning with the market trends, and giving your trades the time to develop. Now, let's move on and let's expand on the key points of swing trading. We've already talked about what swing trading is, but now we'll focus on the specific goals, characteristics, and how to decide whether it's a good choice for you or not. The primary goal of swing trading is to capitalize either on the weekly range expansion and price movements happening within a trading week or the monthly range expansions and price movements occurring within a trading month. As a swing trader, you aren't looking to trade every fluctuation in the market. Instead, you are focusing on the larger moves that aligns with the high time frame objective and the high time frame drawn liquidity. Now let's talk about the key points of swing trading. Number one, limited setups per week. Swing trading typically offers about two setups per week, depending upon the type of approach that you are trading with. If you're trading with the one shot, one kill swing trading approach, then it'll offer you about one to two setups per week. But if you are trading with a classic swing trading approach, then that would most probably than not only provide you with like max one setup per week or maybe one setup per 2 weeks, right? We're going to discuss the types of swing trading further in the video, but the fact of the matter is that it offers limited setups per week, so you have to be mentally and psychologically open to that fact and accept that you're going to have limited setups, and you should be okay with that, because if you're not mentally ready, then you would always feel the urge to force setups because you don't know how to patiently wait for your setups. That's the hardest part about swing trading, waiting patiently for your setup to form instead of forcing a dumb trade idea that doesn't actually aligns with your high time frame context and framework, and that leads you to just stupid losses, right? That doesn't serve you any purpose. Swing trading isn't about constantly being in the markets. It's about waiting for the high probability opportunities and only then engaging with the markets. Number two, higher time frame confluences. The more higher time frame ideas you can find to support your trade, the better, right? We know that. For example, aligning a weekly liquidity pool with daily open high low close key levels or key standard deviations add confidence and precision to your trade. And the more confidences that you can find, the better and the higher the probability of your trade is going to be. And number three, flexibility around news events. Unlike intraday trading, swing trading actually allows you to take advantage of news events and actually use them to your advantage and capitalize on those expansions. Swing traders position themselves before or after news releases and basically exploiting the market volatility for larger moves, because our objective is to exploit the weekly and monthly range expansions, and those range expansion usually occurs after news release events. Now that we've discussed the key characteristics of swing trading, let's talk about the two different models or approaches to swing trading. There are mainly two approaches to swing trading. First of all, we've got the classic swing model, right, which basically focuses on capturing the monthly range expansions. And then we've got the one shot, one kill model, which is a more precise approach, and essentially it targets a single high probability move within the week, and it focuses on exploiting and capitalizing on the weekly range expansion. So the difference between the two of them is that one is a long-term swing trading model, which focuses on capturing the monthly range expansion, and it will offer you even more limited setups per month, right? It will only offer you like 2 to 3 setups per month. And then we've got the one shot, one kill model, which offers you like two trades per week, and your objective and goal is to exploit the weekly range expansion. Now let's talk about why to choose swing trading instead of intraday trading. So, as I said before, swing trading provides a unique balance between the fast pace of intraday trading and the long-term patience of position trading or investing, right? It's especially appealing to traders who want to participate without constantly looking at the charts or monitoring the charts actively, and don't want to have constant screen time. Swing trading allows you to stay active in the markets without being glued to your screens all day like scalpers or intraday traders. Because once your trades are set up, right, and you've placed your stop loss and targets, then you can let the market play out and basically put alerts and then manage trades as the market's price plays out. Uh, Number two, it's appealing to traders who prefer a methodical and planned approach. Swing trading isn't just about quick reactions, right? It's about carefully planning your trades and then executing them properly uh, with a detailed thought process, right? And by analyzing the market over higher time frames, you have enough time in which you can develop a structured trading plan and generate trading ideas with even more precision and accuracy. Number three, it's appealing to traders who aim to grow steadily over time. Swing trading emphasizes on compounding profits, where steady and consistent growth over weeks and months leads to long term success. Moving on, here in this slide, let's talk about the two main styles of swing trading. We've got the classic swing model or CSM and the one shot, one kill model or the OSOK model. These are the these are basically the two sides of the same coin, right? They both focus on swing trading and they are subsets of swing trading, but they do it in different ways. So, depending upon how you like to trade, you can pick the style or approach that fits your vibe. Let's break it down and see which one's for you. First of all, let's start with the classic swing model, or what I like to call the patient traders model, right? Because this model is all about playing the long term game, and your objective is to capitalize and exploit the monthly range expansion. And you're going to let your trade ride for those bigger moves. And obviously, it's going to take a lot of more time to play out, and you're going to have a really limited amount of setups per month, maybe 2 to 3 on average, and 4 to 5 uh, maximum. Now let us discuss the key characteristics of the classic swing model. Let's first of all talk about the trade duration. For trade duration, you're looking at trades that last 5 days to several weeks, or maybe even longer if the trend is strong or we are currently consolidating. Because the classic swing model isn't about getting in and out quickly, it's about letting the market do its thing while you chill in the meantime, right? So, if you are not a chill person, then this is not the style of trading for you. Next up, we've got trade frequency. With this model, you are aiming for about maximum one trade per week, or maybe even less than that, depending upon how many pairs you trade and what sort of market conditions are we currently dealing with, right? You're not trying to hit every single setup. You are waiting for the right setup, the one that is high probability and that aligns perfectly with the bigger picture, because after all, your job is to exploit the monthly range expansion and not the weekly range expansions. And for higher time frame, your main focus is on the monthly and the weekly charts. And lower time frame for the classic swing model is basically the 4 hour time frame. When it's time to pull the trigger, you're going to zoom into the 4 hour time frame for your entries. And the way how you're going to frame those entries is by framing them around either weekly or monthly candle ranges or CRT, right? And that would give you enough detail to spot clean setups without getting overwhelmed by noise. Now, let's talk about why should we choose the classic swing model. So here's the deal. If you're someone who likes to think long term, right, doesn't want to stare at the charts all day and prefers a calm and a methodical approach, then this model's got your back, right? It's perfect if you have other commitments like a full-time job, school, or I don't know, maybe you just want to enjoy life without striking over every single pip or tick. Then the swing model, the classic swing model is for you. The classic swing model is basically like planting a seed and then letting it grow, right? You're not rushing, you're just trusting the process and letting the market play out. Next up, the second approach to swing trading is the one shot, one kill model. Now, let's talk about the one shot, one kill model or the OSOK model. This one is all about short term swings, and your objective in focus is on capturing the weekly range expansions and getting in and out with precision. The key characteristics of the one shot, one kill model are the following: trade duration. The trades for one shot, one kill model last anywhere between 2 days to 5 days. It's quicker than classic swing model or the CSM, but it's still swing trading. Your goal, objective, and focus is on taking advantage of the weekly range expansion instead of the monthly range expansion. And with one shot, one kill model, you're looking at around 2 trades per week maximum, right? That's the double with what you would get with the classic swing model. So if you like a little more action, then this model might be the perfect fit for you. For higher time frame, your focus shifts to the weekly and the daily charts. And for entry, you're going to be using the 1 hour charts, and you're going to frame your entries around daily candle ranges or daily CRT. And you're also going to look for the key levels on the daily chart. Now let's talk about why should we choose the one shot one kill model or the CSM or classic swing model. So, if you are the kind of trader who loves precision and doesn't mind checking the charts more often and wants to catch shorter but high probability moves, then you can choose this model. It's good for you if you like being more hands on with your trades, but still don't want the constant grind of intraday trading. Now, let's put these two models side by side so it's easier to see the difference. So, for the CSM, our focus is on the monthly range expansion, and for one shot, one kill, our focus is on the weekly range expansion. Regarding trade duration, then the trades of the CSM model last around 5 days to several weeks, and for one shot, one kill model, the trade last from 2 to 5 days. Now, talking about the trade frequency, the CSM model offers around maximum 1 trade per week, and the one shot, one kill model offers around 2 trades per week. For the CSM model, our higher time frames are the monthly and weekly chart, and for one shot, one kill, our time frames are the weekly and daily charts, and we're going to be looking for candle ranges and key levels on the daily chart. The lower time frame for the CSM is the 4 hour time frame, and for one shot, one kill model, our entry time frame or lower time frame is the 1 hour chart. Both the classic swing model and the one shot, one kill model are solid strategies or approaches to swing trading. And you need to remember that it's not about which one's better, it's about which one and which approach fits your trading style and your goals as a trader. If you're all about patience in the long game, then CSM is your go to approach. But if you want quicker trades with more frequent opportunities, like most of us, then the one shot win kill model is going to be the best approach for you. The great thing is that you don't have to pick just one. You can experiment with both approaches and see which one feel right for you, because at the end of the day, it's all about building a process that works for you, and for each one of us it's going to be completely personalized and unique to us, that might not be similar to other traders. Now let's move on. In the previous slide, I gave you the higher time frame and lower time frames for both the CSM and the one shot one kill model. In this slide, I'll briefly explain what the purpose of each time frame is, right? Now, you might already know this, but let's repeat it for the sake of practice and to be more critically aware of the objectives of each time frame and what purpose does each time frame actually serve. First of all, let's discuss the higher time frame. For the classic swing model, as I said before, it's the monthly time frame and the weekly. And for the one shot, one kill model, it's the daily time frame. Now, what you're going to do on the higher time frame is that you're going to, first of all, determine the higher time frame drawn liquidity or the directional buys. and you're going to determine both your short-term and long-term drawn liquidity. Now, I've already made a chapter on it, so I'm not going to explain it further. So if you are using the classic swing model, then you're going to determine your directional buys on the monthly time frame. But if you're using the one shot one kill model, then you're going to determine your drawn liquidity and higher time frame directional buys on the weekly and daily chart. Number two, building time and price based narrative. So the higher time frames are used to build time and price based narrative along with determining higher time frame drawn liquidity. And number three, the higher time frames are used to identify and select the correct key levels and candle ranges, right? So for the classic swing model, your candle ranges or CRT and key levels are going to be selected on the monthly time frame. And for the one shot one kill model, your key levels and candle ranges would be selected on the 1 hour respectively. And next up, we've got the lower time frame. Now, what you're going to do on the lower time frame is that first of all, you're going to build a lower time frame narrative, and second of all, you're going to frame entries based on your respective entry model, right? You're going to use the entry model that aligns with the narrative. Maybe it's going to be a turtle soup entry for you or an order block entry model for you. And then last but not least, the lower time frames would be used for managing trades and your execution. So what you're going to do is you're going to set your stop loss based on the lower time frame logic, right? Maybe below a swing low or key standard deviations or an order block. And then you're going to manage your trades by either trailing your stop loss, scaling out at key zones or key liquidity pools, or holding the trade for the full target depending upon the context and depending upon the protocols and guidelines that you've set for your trade management plan. So based on these guidelines, if you're using the classic swing model, then for drawn liquidity, selecting key levels and selecting CRT, you're going to be using the monthly time frame. And for entries, your time frame will be the 4 hour. But for the one shot one kill model, you're going to be doing all of those higher time frame activities on the weekly and specifically the daily time frame. And for your entries, your time frame is going to be the 1 hour time frame. I hope that is clear to you now. Moving on to the next slide. Here in this slide, we're gonna break down the main premises for swing trading for both swing trading approaches, and moreover, we will discuss what key principles makes up both methods of trading. Now, as I said before, for the one shot one kill model, your main guiding principle is to know in which particular direction the next weekly candle is going to expand, right? That is known as the weekly range expansion, and that will be the main guiding principle for you in your high time frame market context and narrative. And next up we've got is the day of the week. In the one shot one kill model, you're only going to find 1 to 2 high probability trades per week, meaning your focus is on quality over quantity. You're only going to be taking trades to position yourself in the direction of the higher time frame drawn liquidity to exploit the range expansion happening on a weekly basis. Now, for that method to successfully work, you need to be aware of the characteristics of each day of the week and the purpose each day might serve depending upon the different combinations of structures and frameworks that we have. And then, based on those protocols and guidelines, you're going to be positioning yourself on specific days of the week based on weekly profiles to exploit either continuation or reversal trades during the week. What you'll do is you'll wait for an anchor point to form on Monday, Tuesday, or Wednesday around a high time frame key level surrounding a CRT, and then you'll frame a setup around that CRT on the lower time frame. Next up is the entry model, entry setup, or framing your entry on the lower time frame. You're either going to do it through a turtle soup entry or an order block entry. If you're going to take the prior approach, then make sure you've thoroughly gone through the turtle soup chatter that I've made, but it's quite complicated as compared to the order block entry, which is pretty simple, mechanical, and methodical in its approach. These three main premises are the backbones of your swing trading models, right? So make sure that your thought process contain each one of them, and they are thoroughly considered with great consideration in your analysis before you generate any trading idea or make any decision regarding your analysis on the higher time frame. Moving on to the next slide. Here in this slide, we're going to discuss the mechanics of how you're going to go about your trading approach. Now, remember, this isn't just for swing trading. This approach, this mechanical and systematic approach that you see right here, that I'll show you in just a minute, stays true for both swing trading, intraday trading, and even scalping, right? This is where we also finally talk about routine, because trading isn't just about a strategy or a system, it's about having a structured approach that you can rely on every single trading day, right? So let's walk through the key steps in the next slide. Moving on, let's finally get real here. Trading isn't just about knowing what's happening in the markets, it's about following a clear and a structured process every single day, right? No guessing, no winging, just a systematic routine that guides you all the way from the preparation to the trade management. So let's break it all down here. So the first step that we've got is preparation or getting ready to trade. Now, the reason preparation matter is that you cannot just jump into the market without a plan, right? Because preparation is where you figure out the bigger picture and actually figure out what's driving the market and where price is likely to go. And what you're going to do is you're going to check high impact news, right? You're going to write down all the key news events for the week. For example, maybe we have an FOMC event, an NFP, CPI, or any other earning reports, right? And you're going to ask yourself, will these events create volatility, and should I avoid trading due to this time, or can I use them to my advantage or to capitalize on it, right? The next thing that you're going to do is you're going to analyze the higher time frame monthly and weekly market structure and order flow. You're going to look at the current trend, and you're going to see either we are rejecting above highs or breaking below lows, or rejecting above lows and breaking above highs, and that will determine the order flow for you. And if none of that is happening, then maybe we are stuck in a range. And if we are stuck in a range, then you can use the range dynamic principles, and you're going to buy below lows and sell above highs. You're going to use this context, right, to build a weekly profile for how the market might expand. And next thing that you're going to do is you're going to find and determine the drawn liquidity on the higher time frame, right? And then inside the dealing range, you're going to figure out where price is likely to go next. Is it targeting a weekly high, a daily low, or maybe a key standard deviation? After you've done all of that, the next thing that you're going to do is you're going to identify and select the correct key levels that aligns with your directional buys, right? And now this key level could either be in the form of order blocks, candle ranges, breaker blocks, or fair value gaps, right? That's what you're going to do. That's your whole preparation step. The second step is opportunity discovery, which means spotting the setup. The reason it's important and crucial is that once you've prepared all of that, it's time for you to find the specific opportunities that aligns with your high time frame narrative, so that you can actually position yourself in a trade and you can exploit those range expansions. You are looking for setups that scream high probability and that have all of that narrative, market context, and confidence is behind it, backing it up. What you're going to do is look for high time frame candle ranges on your respective time frame. You're going to check the higher time frame for clean candle ranges or CRT, which you can potentially use for framing setups around it. And those candle ranges will act as your anchor points for framing a trade idea. And you're going to make sure that that particular opportunity aligns with the higher time frame down liquidity. If your bias is bearish, then you're going to look for setups in the direction lower. But if your drawn liquidity and directional bias is bullish, then you're going to look for longs and buy setups. The key point is that this tip is about building confidence in your setup and bringing clarity to it. If it doesn't align with the bigger picture, then you're going to let it go, right? You're not going to approach the market and you're going to stay risk off. The third step is trade planning, which basically means that you're going to be defining the details of your trade idea. The reason it's a game changer is that because trade planning takes the guesswork out of your execution, and this is exactly where you're going to decide how you're going to enter, how you're going to manage your risk, and exactly where you're going to exit the trade. What you're going to do is you're going to wait for a liquidity purge or a manipulation profile to happen, and after that you're going to look for a confirmation in the form of either an order block forming or a clean rejection after a liquidity purge or the manipulation purge, and this will give you a precise level to base your trade on, right? You can, if you don't want any confirmation entry, then you can straight away take in a turtle soup entry, but for that you need to be fully aware of all of those complexities that turtle soup entries have. But if you want a more mechanical and a systematic approach, then confirmational entry like order block entry or FEG or fair value gap entries might be more suitable for you. And once you've identified your entry point, right, the next thing that you're going to do is you're going to set your stop loss and target. You're going to set your stop loss based on the protocols and guidelines that you've set, that you have based on your entry model. And the same goes for your targets and take profits. And after you've done all of those steps, the last step is trade execution, which means pulling the trigger, right? Now, execution is where most traders mess up, right? You've got your plan now, but now the last and the most important step is to stick to it without messing up and ruining the whole process. And then one last step after that is trade management, which basically helps you stay in control. And the reason this step matters is that once you are in a trade, your job still isn't over. Proper trade management ensures that you protect your capital while maximize your profits and rewards. What you're going to do is you're going to monitor the trade, and you're going to watch how price reacts to certain key levels. Is it moving as expected, or is it showing signs of reversal? And then based off of those key and critical questions, you're going to adjust your stop loss. Maybe if the price is moving in your favor, then you're going to trail your stop loss and uh, lock in some profits by taking partials. But if price is showing signs of weakness or maybe signs of reversal or going in your counter direction, then you go to trail your stop loss to break even or maybe close the trade completely. One important thing about trade management is that make sure that you don't micromanage, right? Make sure that you let the trade play out according to your plan, according to your predetermined plan, and avoid the temptation to close early unless the narrative has clearly changed. Uh, Key point is that your goal is to stay disciplined and trust the process that you've built without micromanaging. Now let's move on and let's discuss some examples and let's break down some examples. So right here you can see this price action chart. On the left we've got the higher time frame, and on the right we've got the lower time frame. And based on the time frames you can see, you can clearly estimate or assume that it's the one shot one kill model, because the higher time frame that is used is the daily, and for entries here you can see the 1 hour time frame, so it's basically the one shot one kill model. What you can see on the higher time frame is the order flow is bearish because we are consistently rejecting above highs and breaking below lows, and our draw liquidity is lower. So what our objective is going to be to expect and anticipate weekly range expansions towards the drawn liquidity lower. and we're going to position ourselves in that particular range expansion uh, around a daily candle range or daily CRT. And what you can see right here is that just before we reached the round liquidity, we stopped and formed this swing low right here and generated even more liquidity. And then we had this small retracement profile. And with that retracement profile, we formed this candle inside this FEG. What you can see right here is that we first of all had inside bar candle within that particular daily candle, and then with this down close candle we purged the candle range high, and then we expanded lower. And in this particular case we would have used that candle range to frame our entry on the lower time frame. And right here you can see on the lower time frame that as soon as we purge that daily candle range, we then closed below the candle that actually purged the candle range, which essentially led to an order block being formed. And then we tested that order block, and then price expanded lower and had the weekly range expansion. And here your entry would have been at the order block low, order blocks low, stop loss above the swing high or the order blocks high, and you would have either targeted the daily CRT low or the overall drawn liquidity on the higher time frame. Now let's move on. Right here again, you can see on the right, we've got the lower time frame, and on the left, we've got the higher time frame. On the higher time frame, the order flow is bearish because we are rejecting above highs and breaking below lows, and our objective is to look for bearish trade ideas towards the drawn liquidity, which is lower. What you can see right here is that after we closed below this swing low right here, we had this FEG formed, and also with that FEG we had this small daily candle which we used as a candle range in CRT. What happened is that on Monday we formed this small daily candle which acted as a CRT for us. Then on Tuesday we purged that Monday's candle range high and took out liquidity and tested the daily